Another big story we're covering for you today, and stock markets around the world are in turmoil this Monday after a massive sell-off in Asia. Tokyo's Nikkei index saw its worst day since 1987. Trading on the Kospi in Korea briefly halted due to the volatility. The loss is driven in part by interest rate hikes at the Bank of Japan. Investors, though, are also jumping ship over fears of an impending economic slowdown in the U.S. and the potential for a wider war in the Middle East, with the sell-off spreading here in Europe as well. We're going to get a bit more analysis about all of this by France 24 business editor Bryan Quinn, who joins me on the set. Bryan, first of all, talk us through what happened in Asia today.
So, Jeannie, as you were saying, a massive sell-off, both Japan and Korea. The Nikkei in Tokyo actually breaking its record for a single-day loss, nearly 4,500 points. That's 12.4%, putting it officially into bear market territory, as it is now down more than 20% from its most recent peak. The Kospi in Seoul, not far behind it, lost to nearly 9%, triggering at one point the market's circuit breaker due to how fast it was falling. And one of the big drivers for this sell-off in Asia, as we were saying, is a strengthening yen. The Bank of Japan has been hiking interest rates and cutting its bond purchases as it tries to exit a long-term economic stimulus programs. Now, those moves have sent the yen up 14% against the dollar over the past 3 weeks. It's up around 2.7% even just today. That's good news and bad news for Japan. It's good news for consumers, as a weak yen has been hurting their purchasing power for a long time now. A stronger yen also good for small businesses that have to import raw materials to make their goods. It is bad news, though, for major manufacturers, particularly Japan's large car makers, whose products will now be more expensive on global markets. Toyota, Honda, Nissan all saw their share prices fall by around 15% on Monday. And the Nikkei has actually been on a bit of a tear this year. It gained around 18% over the first half of the year. Those gains are now erased, but analysts are trying to keep calm about it. Take a listen here.
I think there is some panic selling happening here. The main triggers have been concerns over the US economy, along with interest rates rising in Japan, with an unexpectedly hawkish tone from the Bank of Japan Governor Kazuo Ueda last week. The background is that up to now, short-term investors have been piling into Japanese stocks, and we're seeing those positions being unwound all at once.
And that volatility absolutely being felt here in Europe as this global market rout spreads. On a smaller scale, though, in Europe, London, Paris, and Frankfurt are all down in the neighborhood of around 2%. There we see Frankfurt down 2.2%. The CAC currently here in Paris down around 1.9%. Tech, mining, and banking sectors are all down around 3 to 5% so far.
Bryan, the sell-off, though, didn't start in Asia on Monday. It's a continuation from market losses that we saw last week.
Indeed. In fact, the Nikkei actually fell by more than 5% in Friday's session. And that was a prelude to some significant losses on Wall Street later in the Friday session. The NASDAQ lost nearly 2.5%. Investors around the world are starting to worry that what has looked like a soft landing for the U.S. economy could end up being significantly harder than expected. Earnings reports from major tech firms have been a wave of disappointing figures, and that was before Friday's U.S. jobs report that showed just 114,000 new jobs last month. That's well below projections. Meanwhile, American manufacturing data is also coming in worse than expected. It's all adding up to fears that the world's largest economy is heading for a major slowdown, if not an actual recession. Investors are starting to wonder if the U.S. Federal Reserve has held its interest rates too high for too long to bring down inflation. Many now looking for the Fed to start quickly signaling some significant rate cuts in the coming months.
All right, Bryan, thank you so much for that. That's our business editor, Bryan Quinn.